For 5 years, every financial advisor in America told you the same thing. Do a Roth conversion now, before the tax rates expire, before 2026. Before it is too late. The One Big Beautiful Bill Act made those rates permanent. 7 brackets: 10, 12, 22, 24, 32, 35, 37% locked in. So the question is settled. The urgency is gone. You can stop thinking about Roth conversions. That is wrong, and I have 3 pieces of evidence that it is wrong. The 5-year playbook you followed had one argument. Tax rates are going up in 2026, so move your money now while rates are low. That argument is dead. The rates did not go up. The One Big Beautiful Bill Act locked them in place. And the moment that happened, a very large number of people did something dangerous. They stopped thinking. The window did not close. The view through it changed. What you are looking at when you look through that window in 2026 is completely different from what you were looking at in 2023. The old view was a tax rate sunset. The new view is 3 structural forces that most people have never modeled, and that most advisors have not yet updated their talking points to address. Before I walk through the evidence, the numbers I am about to show you are from published IRS documents, CMS fact sheets, and public actuarial tables. They describe how the tax system works, not what any individual should do. Your situation has variables I cannot see from here. That said, the structure is the structure. Let us look at it. Evidence 1. Required minimum distributions. The IRS requires traditional IRA owners to begin taking distributions at age 73 if born between 1951 and 1959, or age 75 if born after 1959. That is not optional. That is not a suggestion. That is a withdrawal the federal government requires you to make, and it is taxed as ordinary income in the year you take it. Here is where it gets structural. According to Fidelity, SQ4 2024 analysis of 24.5 million participants, the average baby boomer 401k balance is $249,300. The average baby boomer era balance is $257,002. That is the average. Now think about someone with 600,000 or $1 million. In a traditional era. At age 73, the IRS life expectancy divisor is approximately 26.5. On a $1 million era, that is roughly $37,700 of forced income. Every year, going up every year as the divisor shrinks. Remember that number, 37,700. That is the floor, not the ceiling. That forced income stacks on top of Social Security. It stacks on top of any pension, and it pushes people into brackets they never planned for. Not because Congress changed anything, because the IRS schedule made them withdraw it. Take a specific case. A 58-year-old financial planner in Raleigh, North Carolina. Household income $112,000. Married filing jointly, with $820,000 in a traditional IRA. Built over 26 years of maxed-out contributions. Right now, at $112,000 of taxable income, they sit in the 22% bracket. That feels comfortable. Open TurboTax, see the number, close the laptop, move on. Now fast forward 15 years. They are 73. Social Security for the household is $48,000. The IRA is now $1.1 million after growth. The first RMD is roughly $41,500. Add Social Security. That is $89,500 in income. Before they spend a single dollar, they actually chose to spend. And the RMD goes up every year. By 78, the RMD on that balance could be north of $55,000. Total forced income, over $100,000. In the 22% bracket at minimum, likely pushing into 24. For 5 years, everyone said hurry before the rates expire. The rates did not expire, congratulations. The IRS still requires you to take the money out. That is evidence 1. RMDs create a tax escalator that has nothing to do with whether Congress changes the rates. The rates can stay exactly where they are forever, and your effective rate still goes up because the IRS makes you withdraw more every single year. This is where it gets expensive. Evidence 2. Medicare. The Income-Related Monthly Adjustment Amount, IRMAA, is a surcharge applied to Medicare Part B and Part D premiums for individuals with modified adjusted gross income above certain thresholds. According to CMS in 2026, for single filers, the first IRMAA cliff begins at $109,000. For married filing jointly, $218,000. These are not graduated increases, they are cliffs. Go $1 over the threshold, and the full surcharge applies for the entire year. $1 over, full surcharge, full year. Standard Part B premium in 2026 is $202.90 per month. Cross the first IRMAA threshold, and it jumps to $284.10. CMS publishes this. The surcharge is $81.20 per month per person. For a married couple, both on Medicare, that is roughly $1,950 per year. In additional Part B premiums at the first tier alone, add the Part D surcharge at that same tier. $14.50 per person per month per CMS, and the couple is looking at close to $2,300 per year. In additional premiums they did not have last year. Go higher at the fourth IRMAA tier. Modified adjusted gross income between $205,000 and $499,999 for a single filer. The Part B premium is $649.20 per month. Part D surcharge is $83.30. For a couple at that tier, the annual additional Medicare surcharge is approximately $12,700 above what they would pay at standard premiums. Now connect this to the Roth conversion question. IRMAA is calculated based on modified adjusted gross income. From 2 years prior, a Roth conversion counts as income in the year you do it. But here is the asymmetry that matters. If you do the conversion at age 61, you pay the income tax that year. And by the time you are on Medicare at 65, the IRMAA look-back period has passed. The conversion income is gone from your record. If you wait and your RMDs at 73 push your magi above the $218,000 threshold, you pay the IRMAA surcharge every year for the rest of your life. The financial planner in Raleigh. If their RMDs plus Social Security push household magi past $218,000 in their mid-70s, and on a $1.1 million era with a growing RMD schedule, that is not a stretch. They are paying the IRMAA surcharge indefinitely. A partial Roth conversion done between 59 and 65, filling the 24% bracket each year without breaching IRMAA, reduces the traditional ERA balance and therefore reduces future RMDs. Below the cliff. The window did not close. But what is on the other side of the glass is not a tax rate sunset anymore. It is a Medicare surcharge that compounds every year you are alive. The financial planner in Raleigh closes the spreadsheet, opens IRS publication 590B on their phone, closes it, opens the CMS fact sheet instead. Evidence 3, the 10-year rule. The Secure Act of 2019 eliminated the stretch era. For most non-spouse beneficiaries, the replacement is a 10-year distribution requirement. According to the IRS, most non-spouse beneficiaries who inherit a traditional IRA from an owner who died after 2019 must fully distribute the account within 10 years of the owner's death. If the account owner was already taking RMDs at death, the beneficiary must also take annual distributions. During that 10-year window, the entire balance must be zeroed by the end of year 10. Now, think about who inherits. The financial planner in Raleigh has 2 adult children. One is 34, a software engineer in Austin, making $145,000. The other is 31, a nurse practitioner in Charlotte, making $98,000. Both are in their peak earning years, or approaching them, when they inherit that traditional IRMAA. The 10-year rule forces them to distribute the entire balance over a decade. Every dollar distributed is ordinary income, stacked on top of their own salaries. The 34-year-old, making $145,000, inherits $400,000 from the IRMAA, forced to distribute $40,000 per year. Their adjusted gross income jumps to $185,000 after the standard deduction. Taxable income sits near $169,000. That keeps them in the 24% bracket, but barely. A raise, a bonus, a side gig, any additional income in a given year, and they cross into 32% territory. The margin is thin, and they have 10 years of mandatory distributions stacking on top of whatever their career earnings do next. That is their inheritance, paying a rate their own salary never triggered. A Roth IRA inherited by a non-spouse beneficiary is still subject to the 10-year distribution requirement. But here is the difference. Inherited Roth IRA distributions, when the original owner satisfied the 5-year aging requirement, are generally not included in the beneficiary's taxable income. Fidelity's guidance on inherited IRAs confirms this. Inherited Roth IRA assets generally have no immediate income tax impact. Same 10-year clock, radically different tax outcome. For the people who inherit the money, what is your traditional IRA balance right now? If you do not know that number within $10,000, that is the problem. Ed Slott, the IRA specialist, whose 2026 retirement tax playbook was the featured presentation at the Financial Planning Association's event series, describes the current moment as a convergence of the Secure Act, Secure 2.0, and the One Big Beautiful Bill Act that has created what he calls the most sweeping retirement and tax reset in decades. His core argument to advisors: even permanent law is written in pencil, and the window to convert, restructure, and secure lifetime tax control is now. Wealthgen Advisors' 2026 analysis reinforces this. With tax rates now permanent, the firm argues, the focus on Roth conversions shifts to timing, bracket room, and long-term tax control. Their framework identifies 4 secondary filters that shrink the true conversion room: Medicare IRMAA, capital gains, stacking, deduction, Phaseouts, and charitable giving interaction. There is a 4th element I have not mentioned yet, because it only applies through 2028. The One Big Beautiful Bill Act created a new senior deduction: $6,000 per qualifying person aged 65 and older, $12,000 for a married couple both 65 and older. Available whether you itemize or take the standard deduction, but it phases out at 6% of modified adjusted gross income, above $150,000 for joint filers. That phaseout adds roughly 1.3 to 1.4 percentage points to the effective marginal rate for joint filers in the 22 to 24% brackets, with magi between $150,000 and $350,000 during 2025 through 2028. If you are doing Roth conversions during those years in that income range, your true cost per converted dollar is higher than the posted bracket, by a margin most people will never notice on a single return. Over 4 years of conversions, that small margin adds up. to several $1,000s in additional tax, depending on conversion size. The window did not close, the view changed. And there is now a small crack in the frame that only exists for 3 more years. I cover this kind of structural shift regularly. The math changes when legislation moves. The IRS updates the tables. I update the analysis. So, where does this leave you? 3 things are true at the same time. 1. The rate sunset argument for Roth conversions is dead. If your only reason to convert was that rates were going up in 2026, that reason no longer exists. 2. 3 structural forces, RMDs, IRMAA, and the 10-year inheritance rule, create a case for Roth conversions that has nothing to do with rate sunsets, and everything to do with the architecture of the tax code itself. 3. The math is different for every household. A conversion that saves one person $14,000 over 20 years costs another person $6,000 in IRMAA surcharges. They did not need to trigger. 2 places to start. IRS Publication 590B covers the distribution rules for individual retirement arrangements, the full RMD schedule, the Roth 5-year rule, and the beneficiary distribution requirements under the 10-year rule. It is free. It is on IRS.gov. It is the primary source document for everything I just described. Second, the CMS fact sheet on 2026 Medicare premiums and deductibles contains the complete IRMAA bracket table, every threshold, every surcharge amount, every filing status. If you are within 5 years of Medicare eligibility, those brackets should be on your desk next to your last tax return. 2 people with the same IRA balance, same age, same state, different conversion decisions. 5 years later, the gap is 6 figures. That math exists. It is not in this video. The financial planner in Raleigh opens a blank spreadsheet, types 3 column headers, current bracket, projected RMD income at 73 IRMAA, tier at 75. The old question was, should I convert before the rates go up? That question is obsolete. The new question is, what does my tax return look like at 73? And have I modeled it